RBI MPC meeting has updated that the repo rate remains unchanged but the growth outlook has been revised. But this does not answer questions like why the global central banks are decreasing the interest rate but RBI is not easing up the cycle at all. And the most important one for you, that how the repo rate remaining unchanged is going to affect your EMIs. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh and in today's session we are going to discuss in detail that when we look at this announcement where RBI, the MPC meeting, that is Monetary Policy Committee meeting, where we are seeing the repo rate remaining at 5.25% and GDP growth look has been revised up to 6.7%. What does this exactly mean? And most importantly, when we are looking at the global landscape where central banks are decreasing their interest rate, why RBI is moving in the different direction. So when we are looking at the present announcement that has been made and when we see the major things that have been announced, the primary one being the repo rate remains unchanged at 5.25%, but when we are looking at the other metrics such as standing deposit facility, it is 5.00%, marginal standing facility at 5.50% and bank rate at 5.50%. Now, before moving ahead, let us briefly understand what exactly are these. Now, when we are looking at repo rate, it is the short-term fund rate which commercial banks are charged from RBI. When we are looking at bank rate, it is basically the long-term rate that RBI charges from the banks, and bank rate serves as a reference rate for any penal charges or the financial charges if they occur. But when we are looking at SDF comes into the picture when the commercial banks are trying to park their funds in RBI without any collateral. And when we are talking about MSF, this is an emergency borrowing situation. So when the commercial banks are borrowing in an emergency for overnight, this is when MSF comes into picture. So if we are looking at the policy rate corridor, it starts from SDF and then it exists up and until MSF. So at 5.00% we have SDF, then in between we have repo rate at 5.25 and then we have MSF. So this is the policy rate corridor. Now going back to the announcment, the monetary policy stance has been announced as neutral. Many experts in this situation, they were expecting that the neutral stance of the monetary policy will probably be changed this time, but RBI did not do that. RBI kept it neutral and RBI said very clearly that any future decision, not just about the policy rates but also about the monetary policy stance, will be data based, will be understood based on what we see unfolding in the economy next. So when we are looking at this situation, I think we will be able to conclude on the fact that RBI is trying to gauge where the economy is going, what are the global factors that we need to consider before changing anything at all. Later we will be also talking about those factors which RBI is considering, but let us straight up move to the question I think that you all might want answer to, the fact that how it directly impacts your EMIs. So when we are looking at this whole system, first you have to understand that RBI's repo rate decides the bank's borrowing cost, because this is the rate for short-term funds, correct? Now bank's borrowing cost is going to help in deciding the lending interest rate, at what rate the bank will give loans, and then that will be the benchmark for all the other loan interest rate. Based on that, your EMI will be figured out. In this context, this is the primary benchmark. This is going to affect your monthly EMI. This is how monetary policy transmission actually takes place. But one thing that we need to remember here clearly, that the moment RBI says the rate is decreasing, or if the rate is increasing, or it remains unchanged, in any of these scenarios, the transmission is not immediate. It's not that the immediately borrowing cost will change, the lending interest will change. No, the transmission takes time, because there are a lot of other things that banks do charge for. So when RBI changes its interest rate, let's assume for a minute that this MPC meeting, the announcement was that the rate is reduced. So it was not like that this very month your monthly EMI will reduce. But of course, because the rate remains unchanged, your monthly EMI, the previous borrowers who have already taken any sort of loan, your monthly EMI also remains unchanged. However, for the borrowers who might be coming into the picture next, the earlier cuts that have been made, that might be taken into consideration because the transmission of the earlier cut, can you tell me in the comment section when was the last interest rate, repo rate cut made? That will have been transmitted by now. So that can definitely help the new borrowers. Now that we have answered and understood, let us straight up move to understand that when the global central banks as of now reducing their interest rate, why RBI is moving in a very different direction. So this has very clear reasons in front of us. When RBI opted for a neutral stance, that means RBI is trying to gauge something. RBI is trying to understand where the economic indicators are going to move, and based on that we will act. But when we are looking at global economies, their indicators are out. For example, there is weaker growth. GDP growth rate in the strongest of the economies is not sound. But for us, we remain one of the major growing economies. If you have to trust the number, then we have been told that across the world, we are the fastest growing economy as of now, which can be understood by the revised number that has been put forth by RBI as well. When we are looking at global economies, there is a situation of falling inflation. Once in between the West Asian crisis probably dialed down a little, the inflation previous to that also they have seen on the negative end. So if inflation is falling, the consumer demand is low, that means in that situation government needs to come into the picture and give a stimulus. What can be the stimulus? The reduced rates. If the rates are reduced, the lending is easier, the money supply can increase, correct? But when we are looking at India's scenario, this is something different. Our growth numbers are good, but one big thing that RBI is trying to gauge is inflation. As of now, inflation is breaching the 4% to 6% target that RBI has, and it has gone above 4% target. The consumption, the consumer demand in our domestic economy is strong and upwards. And because of these two factors, RBI thinks it is a great time to stop and watch. RBI is not moving into the other direction. RBI is adhering, understanding what exactly is happening in our country, and based on that, the stance has been kept neutral and the repo rate remains unchanged. In this context, you also have to understand that the picture for RBI is very different as compared to other global economies. You might be thinking how in that particular context, let us clearly understand that RBI does face a lot of additional risk as well. Now, what are these risks we are talking about? RBI has also clearly mentioned, and we can also clearly understand that India as of now can clearly understand that how volatile we are in terms of crude oil. How choke point are choking our economy. In this context, I am talking about Strait of Hormuz. Then to add to that, we have domestic factors such as monsoon uncertainty. In the start of the year, it was understood that a Godzilla El Nino is going to cause deficit rainfall. But now we have seen the situation reversed because of certain weather patterns which have facilitated good amount of rainfall, but certain regions are seeing flood-like situations and certain are deprived of rainfall. So this monsoon uncertainty, and club it with the food inflation. And we have already talked about choke point, that also brings into the picture the imported inflation. Now let us understand the results of this. So if in this context, in the present additional risk, RBI reduces the rate just like other global economies. So one, we are looking at the monsoon uncertainty. Now the supply, the food production is dipping. people will have the money supply in the economy will increase. If the money supply in the economy increases, there will be a disruption. The prices will skyrocket, which are already in terms of food increasing. So there are a lot of things that RBI wants to keep in consideration, because RBI feel if we make a premature cut, that will lead to increased borrowing, yes. That will lead to boost to consumption, the consumer demand, yes, and inflation will be reignited. So our situation and RBI's stance is very different based on factors which are not seen to the global economy. Now the question is, when we are talking about continuously the inflation targeting by RBI, how RBI exactly does it? So let us try to understand that first. So when we are looking at Reserve Bank of India, what Reserve Bank of India in simple word tries to do is to control that how much you can borrow, right? Because you will be borrowing from the banks. RBI controls the rate of the banks. Based on that, RBI is trying to ensure if the rate is higher, then you will borrow less because loans will be costlier. If the rates are lower, you will borrow more. Now the question is, what happens because of borrowing? What is the RBI's problem or RBI's solution in terms of borrowing? So in a situation where borrowing increases, that will only happen when the rates are lower, and in a situation where borrowing decreases. Both of these situations affect the growth, inflation as well as employment. For example, if borrowing increases, that means the consumption will increase, that means demand for goods will increase. That means if the demand is increased, people would have to manufacture, it can provide a stimulus to growth. Similarly, if the demand is increasing, it will not be immediately met with supply, not for all the goods, it will increase inflation also. But if the manufacturing production is being increased, it will give employment as well. So when we are trying to increase borrowing, it does impact the economy, growth, inflation, employment. But when we are trying to decrease the borrowing, why are we trying to do that? We are not trying to control the growth, we are trying to control inflation. And when we are trying to retain inflation, we have to take away the consumption demand. How will that demand go? If you have money in your hand, more and more, the easier you will be making EMIs, you will be demanding more goods. So that is why RBI uses the rates to control that what amount of inflation will exist in the economy. And RBI uses multiple tools to do so. RBI has quantitative tools also and qualitative monetary policy tools. Now, based on the situation, RBI navigates, and as if now RBI is not able to decide what situation it is. Is it the time to put the brakes and control the inflation? Because once you will control the inflation, the growth numbers might be compromised. Or is it the time to let borrowing go ahead and inflation will remain intact? So in order to ensure that, RBI has a pretty clear framework where they have kept an inflation target. Target is 4%, but the tolerance band can be from 2 to 6%. That means 4% plus minus 2%. That is why I mentioned the range of 4 to 6%. If it crosses 6, that is when it is a big problem. If it crosses 2, again big problem. But the maintenance is to be around 4% itself. Now, in order to ensure this, RBI not only looks at simple one number, RBI looks at multiple indicators such as CPI inflation, core inflation, GDP growth, how much liquidity is present in the economy, exchange rate, oil prices, food inflation and global financial conditions as well. And when the cumulative of this shows that growth, inflation, which needs to be targeted, RBI decides to increase or decrease borrowing based on that. And this is the simple framework that RBI uses for inflation targeting. Because RBI's motto is economic growth but without compromising on price stability. And that is why RBI has decided to pause, that means make no changes, be neutral, observe and then take actions. And the reasons RBI has also been very clearly given that we are facing domestic challenges, we are facing global challenges, that is why we are taking the pause. Now what are these domestic challenges and global challenges? Domestic risks such as inflation above 4%. When we are looking at food price, there is uncertainty. When we are talking about the Kharif output, that is not finalized yet. When we are looking at global challenges, crude oil, West Asia conflict, Red Sea shipping disruptions, when we are talking about bubble Monday, all these challenges are present and lingering. And that is why RBI feels that if inflation is not fully under control, global uncertainty is not clarified, and this is the time to remain paused. Why? Because this will give us a chance to act in a better way later. I hope this gave you a fair clarity that why today RBI acted in the way it acted. If you have any doubts, you can put it down in the comment section. Now I will be leaving you here with a revision box which gives you a clear understanding of Monetary Policy Committee. And in the end, we have a prelims practice question here. Very simple from the monetary policy tools of RBI. Let me know the answer to this in the comment section. I'll be waiting for your answers. That was all from my side. Thank you so much.